Okay, good morning. Today we are going to finish up Chapter 5. Just know that Learning Catalytics, there is a question there. The session ID is on the screen, and Haley will keep putting it in the chat room as people arrive. So there is a question. We'll get to that in a few minutes. Just a refresher on administrative announcements. Okay, Saturday, Chapter 5 homework is due. Section 3 also has a regular quiz in addition to the homework. Friday we have an optional session. I think this one will last maybe half an hour from 8 to 8:30, and you can attend that. If you'd like extra help, you can also ask questions during that session. Haley had a lot of people stop by on Tuesday. The last day to review your exam to see what you did right or wrong on it is tomorrow. She has hours from 11 a.m. to 1 p.m. in room 579 in the College of Business. And that's Thursday. And then we're into Chapter 5. Okay, so what we're going to do right now is we're going to start with the Learning Catalytics question that's out there. So go ahead. Did you blow it up? Okay, so the question is, Scribbles purchases paper products on account from OfficeMax. Which company has an accounts receivable? So we'll leave this open for about a minute. Okay. Okay, we have 30-second warning on this one. We're going to close it and go to another one in 30 seconds. See what time is 30 seconds. I don't know how you do that, but. Okay, Scribbles purchases paper products on account from OfficeMax. Which company has an accounts receivable? And the answer there would be OfficeMax. OfficeMax accounts receivable is the company that has the customer. So when somebody sells something to a customer, they have an accounts receivable. In this case, Scribbles has an accounts payable, which is a liability. Okay, we have one more review question and we'll get to the new material for today. Okay, this goes back to what we did Monday. When goods are shipped FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. True or false? When goods are shipped FOB destination, revenue is recognized by the seller when the goods leave its shipping dock. True or false? 5 more seconds on this one. When goods are shipped FOB destination, revenue is recognized by the seller when the goods leave at shipping dock. True or false? When goods are shipped FOB destination, revenue is recognized by the seller. Actually, it's recognized when the goods arrive. FOB destination means title transfers at the destination, and that's when revenue is recognized. So this one is false. Okay, so back to the material for today. On Monday, we were talking about accounts receivable. And accounts receivable is what our customers owe to us because they bought stuff from us. Now, some customers will not pay us, and we have to have some way to estimate what that is. We don't know which customers won't pay us because if we did, we wouldn't sell to them. So we have 2 methods to estimate our uncollectibles account, because what we're trying to do is match the uncollectible expense to the sales revenue. So we sell something, we want to match the uncollectible account expense with those sales, even though we don't know exactly who's not going to sell. So we have 2 ways to estimate that. The first one is percent of sales method, which is the income statement approach. Now, the percent of sales method, the income statement approach, is we did that on Monday, and that's basically taking a percent of the sales and saying, okay, this is our uncollectible account expense. The aging of, and we did that on Monday. And the aging of receivables method is a balance sheet approach. An aging of receivables method, what we do is we look at what's due, then we look at the ones that are really past due and take a percentage of those. And we'll see that today. Okay, let's step back. Okay, so starting with percent of sales, we're going to review this again and then go through an example and then do aging schedule. So percent of sales method, we take the estimated uncollectible percentage times the sales revenue equals uncollectible account. This isn't anything new. We did this on Monday. So we're going to apply it to an example here. Okay, so assume it's September 29th and Apple's accounts have these balances before year end. Apple's year end was September 29th, 2012, by the way. Apple has an odd year end. So accounts receivable, which accounts receivable is the asset, has 11,028. Amounts are in millions. And the allowance for uncollectible accounts is 10. Now notice the allowance for uncollectible accounts has a credit balance. It is a contra asset, meaning that it offsets accounts receivable. Accounts receivable has everything that everyone owes us, and then allowance has this estimate of what we think we might not get. So if we take our accounts receivable and subtract our allowance account, we get what's called the net realizable value. And the net realizable value is what we think we're going to collect ultimately. So in this case, Apple's credit department estimates that uncollectible account expense is 0.0005 of total revenues, which are 156,508. So we're going to do the journal entry then, that 0.0005 at the top of the revenues. Let me see. Okay, we take the 156,508, and this is the middle, the bold line in the middle, times that 0.0005 gives us 78, basically. So this is, we're estimating the uncollectibles based on their sales. So we're told that Apple sales, and these are real numbers, 156,508 times their percentage, which is the 0.0005, and we're told that it's 78. So then when they go to do their uncollectible account expense, all they do is debit uncollectible account expense for 78, credit allowance for uncollectible accounts for 78, and that's it. This journal entry, every time you have percent of sales method, this is what you do. You debit the uncollectible account expense, which is a debit because it's an expense, and you credit your allowance for uncollectible accounts. So your allowance account is this contra asset, and it holds this estimate of what you think you're not going to be able to collect. So it just holds everything, because you want all the original amounts in your accounts receivable, because you're still going to try to collect from everyone. The key here is you don't know who's not going to pay you. So you have this estimate in the allowance account. Yeah. Is what always given to you? Yes, the percentage will always be given to you, yes. You'll be given the sale when you're doing this method. When you're doing the percent of sales method, you'll be given the sales and the percent. And you just multiply the two. So this one's the one that's easy to do. You take your percentage times your sales and you're good. And the journal entry will always be to debit the uncollectible account expense and credit allowance for uncollectible accounts. So that's a good journal entry to have on your sheet, to not have to figure it out every time, because it's always going to look like this. Okay, so we have that journal entry. Now we're going to look at, from a T account standpoint, what's going on. Wow, that spacing's off here. Let me see if I can set. Wow, I don't think I can fix this one this quick. Okay. Okay, ignore my, they're off here. Okay, let's assume that our balance for uncollectible accounts before the end of the period has a $10, I'm ignoring millions. So accounts receivable has a balance of $11,028, and allowance for uncollectible accounts has a balance of 10. Allowance for uncollectible accounts has a credit balance, so that's where we're starting. And then our adjustment that we just made with that journal entry is we credited allowance for uncollectible accounts for 78. Okay, so we would have a credit to that, and then our balance then in the T account is 88. I guess I could put it up here. Okay, so the T account is going to have that $10 credit balance to start with. We had a $78 credit, so then the balance of the allowance for uncollectible accounts is 88. So then if I take my accounts receivable of $11,028, subtract the 88, and the reason I'm subtracting it is we have the accounts receivable account, which has a debit balance, which it's our asset, $11,028. Then we have this offset, this estimate of what we're not going to collect. We subtract the 88, and what we get is this net accounts receivable here of $10,940. That's referred to, I don't have it written on the slide, but that's referred to as its net realizable value. Sometimes we shortcut it and say net, accounts receivable net, or the net realizable value. That's how much we actually expect to be able to collect from our accounts receivable. But we don't know who's in the 88. That's our best estimate based on historic experience. So we've set up this allowance account. We have this amount that we think we won't collect, and the expense for the period for uncollectible account expense will be 78. So that's where their debit's going. So that's what's happening with the percent of sales method. The percent of sales method is the easiest method to do, and companies use it frequently. Okay. But there's two methods to do it. So that was one, the percent of sales method. The other method is the aging of receivables method. Now the aging of receivables method is known as the balance sheet method because what we're going to do here is instead of saying here's our sales times our percentage, we're going to say let's look at what is actually due. Let's look at all those accounts that are actually due, and we know that the longer an account is past due, the greater the chance that they aren't going to pay. So we're going to look at how past due things are and apply percentages to those past due buckets and come up with an estimate of uncollectible accounts that way. So you take, you're basically taking your uncollectible percentages that you're given times balances in accounts receivable to get what your allowance should be. So this takes a couple extra steps. It's not as straightforward as the percent of sales method. But you could argue that this method is maybe a little more accurate. Okay, so back to our example. Now we're doing the same example except we're going to use the aging method. So same example, we have an accounts receivable balance of $11,028. And the allowance for uncollectible accounts has a $10 credit balance to begin with. Okay, so that's what we're given to start with. Now, the sentence that we're told is accounts receivable aging schedule shows that the company will not collect $98. So here we're just told the company's not going to be able to collect $98. Where did they get the 98? Well, the 98 they had to do a lot more work to get to. We'll come back to this, but I want to show you. Exhibit 5-3 in your book actually has this example. But what they've done is they prepare an aging schedule. An aging schedule, you will not have to prepare one, but an aging schedule tells you how much is past due. So for example, in this, in the 1 to 30 days category of how past due they are, they have 10,164. In the 31 to 60 day past due, they have 600. 61 to 90 days, 200. So they go all the way across the board with, I guess it's how many days since their invoice. So that 1 to 30 day, those people really aren't past due. It's only when you get into 31 to 60 days, 61 to 90. And what they do then is once they divide up all their accounts receivable by how many days since the invoice date it's been, then they apply percentages to each of those buckets. Now for the 1 to 30 day bucket, that's where most of our customers are, and they just haven't paid yet because their bill isn't due yet. So of that pool, we expect most of those people to pay. So they've come up with these percentages over time. They use 0.75%. But then when you get out to the 31 to 60 day bucket, so these are people, it's been 31 to 60 days since their invoice date. Then we're going to apply a 1% rate to that, a little bit higher rate, because the more past due something is, the more likelihood is that we're not going to get paid for it. So then if you go out to the 61 to 90 days, we're using a 5% rate. And then over 90 days, 10%. The more past due something is, the more likely it's not going to be paid. So what they've done, they've applied those percentages, and they came up with this allowance for uncollectible accounts estimate of 98. So they did that for us. We got the estimate of 98. What they're telling us is, back to here, this last sentence where the schedule shows the company will not collect 98, they're telling us that this allowance for uncollectible accounts, that contra asset, should be 98. That's what they're telling us. So instead of saying, here's our sales, take this percentage of it, they're saying, wow, we've gone through, we've aged our accounts receivable by how far due it is. And this is our best estimate of what we're not going to be able to collect. So instead of $10 balance in that account, we should have 98 is what we're coming up with there. Okay, so we have to take the balance of that allowance account from $10 to 98. To do that, we take the 98, subtract the 10, and we get an adjustment of 88. So when we're doing the aging method, we're given what the balance should be. We know what it is, so what do we need to do to get there? So it's a very different way of getting to the same idea that we're estimating our uncollectibles. And the numbers will be different. Companies don't use both methods. They pick a method and they go with it. It depends what they're looking for. The percent of sales method, it's easy to do. It's an income statement approach because what it does is it matches uncollectible accounts expense with the sales revenue. The balance sheet method, the aging method, produces a better estimate of the allowance. So it says your balance sheet's going to be more accurate. So we have to pick one. So what we're going to do here, same journal entry, just the amount's different. So again, just like with the percent of sales method, we're going to debit uncollectible account expense, credit allowance for uncollectible accounts. Okay, so those are our two methods. We're going to do a quick question and then go on. Okay, the allowance for uncollectible accounts is classified as what type of account? Looking over your shoulder here. Okay, that allowance for uncollectible accounts is classified as what type of account? We're going to have it open for another 10 seconds. Okay, allowance for uncollectible accounts is a contra asset account. The allowance for uncollectible accounts is always shown with accounts receivable. It's an offset. Accounts receivable lists everything every customer owes us, and then we show it with this estimate of what we're not going to collect. We don't want to show assets on our balance sheet that aren't truly future economic benefits, but we don't know which ones don't work, so we can't specifically write them off. Okay, so we have this estimate. Oh, did you already start it? Okay. Okay. We have another one. There are two basic ways to estimate uncollectibles, the direct write-off method and the allowance method. True or false? We're going, I'll just let you know if we want to do that one or not. Yeah, it's okay. It's okay. But we will do this one. Okay. Not now. Okay, two basic ways to estimate uncollectibles, the direct write-off method and the allowance method. Another 5 seconds or so to ring in on this. Yes. Okay, 5 seconds. This one is false. The two methods are the percent of sales method and the aging method. Those are the two methods to estimate uncollectible accounts. just so she knows, hers were okay last week, Monday. Do a chat window tech support, she should ask. Okay, so we have these two methods to estimate uncollectibles. So when we estimate uncollectibles using the percent of sales method or the aging schedule, those are two ways to estimate because we have no idea who's not going to pay us. But there comes a time when we know absolutely someone's not going to pay us because they've declared bankruptcy or something like that. This is called writing off the uncollectible account, actually writing it off. So we've estimated all along, and there comes a time when we have all these accounts and accounts receivable, and maybe we have a couple accounts for people who have declared bankruptcy or gone out of business, and there's absolutely zero chance that we're going to get paid back. Now these accounts, we just want to get them out of accounts receivable. We make the assumption that these were the accounts that we were estimating for. These are not new accounts we're writing off. These were those ones that we made the estimates of. So now what we want to do is we want to get rid of these accounts. We want to get rid of accounts that have specifically gone bad. Okay, so let's say Apple has 3 accounts receivables, one from RS, one from TM, and then everything else. So we have these 3 accounts, the 9, the 3, and the 11, 16. So those added together are their entire accounts receivable, and they have an allowance for uncollectible accounts of 98. So those are the basic facts that we're given. Now in our example, we're going to learn that, okay, so total accounts receivable, 11,028. So these are all our accounts receivable, and we're going to show what happens when we find out that we cannot collect an account. So we're making the assumption that that's one of those accounts that we estimated for. Okay, now net realizable value of accounts receivable down there at the bottom is the 11,028 minus the 98. It's accounts receivable minus the allowance account. Now, in this example, we're learning that the first accounts receivable, RS, the customer RS, it's learned that RS has gone out of business and cannot pay. Okay? So Apple could continue having this $9 accounts receivable in the assets, but it doesn't make any sense because at some point this is absolutely not collectible. We want to get it out of our assets. We want to get it out of the estimates. We say, okay, we estimated for it. So what we're going to do is we're going to write off that account. So we determined early in fiscal 2013 that we're not going to be able to collect from RS. So what happens then is we want to wipe that account out. So we're going to debit the allowance for uncollectible accounts and credit accounts receivable. So we're going to, when we write off an account, so this is writing off an account that's gone bad, that we can specifically identify. So we're going to debit account allowance for uncollectible accounts, credit accounts receivable. This is one of those journal entries you want to make note of. You want to include it on your sheet. This is what happens when you write off an uncollectible account. When you do this write-off, what you're doing is you're debiting allowance for uncollectible accounts. That has a credit balance. It's a contra asset. So you're taking it out of allowance for uncollectible accounts, and you're also taking it out of accounts receivable. So this bottom box, what I've got is you're increasing assets with that debit and decreasing assets with the credit. So there is zero impact on assets from this transaction. So this entry where we had allowance for uncollectible accounts, we have the debit to allowance for uncollectible accounts, credit to accounts receivable. What we're going to see then is that debit for allowance for uncollectible accounts will debit the T account, will credit accounts receivable, and then we'll end up with 0 being in accounts receivable for RS, and total allowance for uncollectible accounts of 89. My spacing's off when I converted to. There we go. So when you write off an account, it has 0 impact on income. It has 0 impact on assets. We're simply saying, oh, okay, we found that this account, this RS account here, was one of the accounts that we estimated for, so we just want to take it out of allowance. Okay, now there's some very specific terminology to know. Write off uncollectible account. The first thing we did when we had the aging method and the percent of sales, that was estimating uncollectible accounts. That was estimating. What we're doing here, we're writing off an uncollectible account that we've discovered is uncollectible down the road. So we just want to remove it. So it gets removed from accounts receivable. It gets removed from allowance. So we have 2 different things there. We have estimating uncollectible accounts, which is what we did in the beginning. We have this, which is writing off one account that's determined to be uncollectible. And then the last terminology that can be confusing. So we have estimating, writing off, and then we have something called the direct write-off method. Let me get to it. There we go. Okay. The direct write-off method is yet a third term, and it's different. The direct write-off method says, let's not have any estimating going on at all. Let's just wait till a customer's account goes bad, and then we'll write it off. The direct write-off method is not acceptable for under generally accepted accounting principles. We have to make estimates. We have to accrue for it. So the direct write-off method is yet another specific term, and it refers to the situation where we've decided we're not going to estimate any collectibles, and we're not doing it in accordance with generally accepted accounting principles. Pardon me? From a when is it used is the question. It's used by very, very small companies that don't use generally accepted accounting principles. And we're not going to go through how to do it. It's just this is not acceptable. You have to make some kind of accrual or adjustment for it. We're going to be doing homework short exercise 5-8 next up. Okay. And we've got, this is a allowance method. We have during its first year of operations, this company has sales of $483,000 all on account. That's telling us that all of these sales people come in and say, we'll pay you later. Industry experience suggests that their uncollectibles will amount to 2% of credit sales, so they're giving us the percentage there. And at December 31st, accounts receivable total $49,000, and they use the allowance method. So they're using the allowance method to estimate uncollectibles. It doesn't specifically say percentage of sales, but that's the only information we're given. So we're going to use it. And number one, it says make the journal entry for uncollectible account expense using the percent of sales method. So what we're going to do here, that journal entry will always look the same. So we don't have to wrestle with figuring it out. We refer back to our list of journal entries. When we do this journal entry for uncollectible account expense, we're going to debit uncollectible account expense and credit the allowance account. And that amount will be the amount of sales of $483,000 times 2%. So we end up with $9,660. So that we will debit the uncollectible account expense and credit allowance for uncollectible accounts. Yes. See where it says uncollectible account expense 483,000 times 2? You see where you see the 9,660? Look to the left of it to calculate. Okay. So you're taking the sales times the percentage. So the percent of sales method, you're taking the percentage times the sales. Your journal entry is always going to debit uncollectible account expense and credit allowance. Next requirement here says show how the company would report accounts receivable on its balance sheet. So what we're going to see there is we're going to have their accounts receivable balance, which is given to us in the problem. So it's given to us as $49,000, one of the last sentences in the paragraph, less the allowance for uncollectible accounts of $9,660 gives us accounts receivable net of $39,340. So the allowance account is always subtracted from the balance of accounts receivable to get our net realizable value. So we had our balance sheet, accounts receivable less allowance account equals our net realizable value of accounts receivable. What we're going to do now is we're going to go into the last learning objective for the chapter, which is another kind of receivable, which is notes receivable. Now, accounts receivable is when we sell goods or services to customers. There's typically not interest involved, and this is typically credit terms will be you pay us in 30 days, no interest involved. Now when we get into notes receivable, there's interest involved. There's actual legal document. So we have a lot more vocabulary with okay. Okay, learning objective 5. Okay, we have a lot more vocabulary. So we're going to go, the vocabulary in learning objective 5 is half the battle, is knowing what's being asked for and knowing the terminology. So first of all is a creditor. The creditor is the party to whom money is owed. It's the lender. So that is the creditor. The creditor will have the note receivable. The next term down, the debtor. The debtor is the party who borrowed the money and owes the money. also known as the maker or the borrower. The next term down is interest, and the interest is cost of borrowing money. I mean, we've heard of interest. Interest is on mortgage loans, it's on car loans, and it's what we pay to borrow money, and it's stated as an annual percentage rate. So even if you see a 30-day note, the percentage on it is stated as an annual rate. It's going to always be expressed as an annual rate, even if the term is shorter. Connection issues, they can always call Blackboard Collaborate for help. You know, I mean, so we can't diagnose it, but okay, next one down, the maturity date. The maturity date is the date when the debtor must pay the note. Okay, the maturity value of a note is the principal plus the interest. So it's the amount we borrowed plus the interest. That is what's referred to as the maturity value. And then principal actually was part of that. It's the amount, principal was what we borrowed, how much we borrowed. So the maturity value is that principal plus the interest on the note. And then the term finally is the length of time from when the note was signed to when the payment must be made. When we have a note receivable, from an accounting standpoint, we're going to have to classify it as current or long-term. Current means it's due within 12 months. So it's either more than a year out, due more than a year from now, or within a year. Current is within a year because as an investor, I'm looking at a balance sheet. I want to know liabilities-wise what's current, what's long-term. I want to know asset-wise what's long-term and what's short-term. I'll leave this up here for a minute, but there is a Learning Catalytics question pushing out right now. Okay, go ahead and switch it over. Okay, so our question right now, the maturity value of a note is the sum of the principal less interest due at maturity, true or false? Read the question carefully. Right now, it's about a 50-50 split of people getting this right. The maturity value of a note is the sum of the principal less interest due at maturity. Change your answer. I see a bunch of answers are changing. That's good. Okay, about 5 seconds on this. Get your answer in. Okay, the answer is false, and the reason it's false is maturity value is the principal plus the interest at maturity. So you have to watch carefully. In business, when you're reading contracts and signing up for things, every word counts. This is false because it's the principal plus the interest at maturity. Okay, So now we're going to do short exercise 511 because this is a way to compute. I'm going to show you how we do interest and on a note. So we're going to use this exercise to illustrate what we're talking about. So it says compute the amount of interest during 2014, 15, and 16 for the following note receivable. Okay, so we have a note receivable. A bank is loaning money. So on May 31st, 2014, Main Street Bank lent $220,000 to Ron on a 2-year 5% note. So some things to note here. That 5% rate is an annual rate. So it's 5% per year. This note did not start on January 1. It started on May 31st. You don't count the date of the note. It's always the day after the interest starts. And we're going, if you're talking about a year, you do it by months. Okay, so we'll look at how many months we had it. If you have a 30-day note, you do it by days. So basically, your choice here is we're going to do it by days if it's a 30-day note or if it says number of days. Otherwise, we're using months for the interest. So let's calculate the interest, calculate the amount of interest during all 3 years, 2014, 2015, and 2016. So in 2014, the money was loaned. The bank lent the money. So 2014, it's going to be the $220,000 we lent times the 5% rate times 7 months out of 12. How did I get 7 months? Well, 7 months is the amount that this was outstanding. We loaned it on May 31st, so May doesn't count. So we have June, July, August, September, October, November, December. It does not hurt to count on your fingers. Sometimes you can get off by 1 month and then the whole thing's wrong. There are 7 months left in 2014. So to calculate the interest, we'll take the principal amount, $220,000, times the interest rate, which is 5%, 0.05, times 7/12. So 7 months. That's going to be June through December is 7 months. So that's how we're getting this adjustment. So it rounds to $6,417 is the amount of the interest. Okay, now the next one asked is they're asking about 2015. So 2015, the 2015 interest is going to be, we held it the whole year. So 2015 is going to be the easiest for us. We can just go to 220,000 times the 5%. So we don't have any partial month adjustment because the note was outstanding the entire year of 2015. So 11,000. So we could do it times 12 months out of 12, but it's going to be the same thing. And then 2016, again, we're going to have a monthly adjustment because it matures. It's a 2-year note, so it's going to get paid off on May 31st, 2015. So we would have 220,000 times 5% times 5 months. Where I get the 5 months. That note was outstanding January through May of 2016. It matures 2 years from when we've loaned the money. So 5 months in 2016, so we'll take the 220,000 times 5% times 5/12. Okay, so now we've calculated the interest for all 3 years. Now we go on to part 2, and part 2 is asking us a series of questions. So part 2, which party has a note receivable? So which party has a note receivable? We've got 2 parties. We have 2 choices. We have the bank and we have Ron, right? So which one loaned the money, basically? And that would be the bank. the bank loans the money. Now the next one down, note payable. So we have the bank for A. Note payable, who owes the money? That would be Ron. So we have the bank loaning the money, we have Ron borrowing the money. Then who has interest revenue? The party that has interest revenue is going to be the party that loans the money. The bank is making interest, has interest revenue. So the mirror image of the bank then for D is who has interest expense? It would be Ron. So basically for A and C it's the bank. B and D it's going to be Ron. So the note receivable has interest revenue. The note payable has interest expense. Okay, and then the third requirement here, how much in total would Main Street Bank collect if Ron paid off the note early, say on November 30th, 2014? So we have to pay a lot of close attention to what year we're talking about. This note was made on May 31st, 2014, and they're saying now assume he paid it off in November. So you have to count how many months go from June 1st, because the day we loan the money doesn't count. So June 1st through November 30th, that would be 6 months. So what we're going to see here is the $220,000 times the 5% rate times the 6 months. We'll have the principal plus the interest, so the total payoff would be $225,500. Did we do that one today? Mm-hmm. That one? I don't think we did. Oh. Mm-hmm. Okay, we're doing this one. Okay, now we're going to do a couple questions. So we're going to go back to learning catalytics. And Haley's pushing it out. Well, you don't have to show it quite yet. Yeah, that's good. That's good. Yeah. Okay. The net realizable value of accounts receivable is the difference between accounts receivable and what? No, I'm going to, this is, I'm going to do this now. Mm-hmm. Okay, the net realizable value of accounts receivable is the difference between accounts receivable and what? We've got about 5 seconds left to click in your answer. Okay, so net realizable value Net realizable value of accounts receivable is the difference between accounts receivable and the allowance for uncollectible accounts expense. Okay, and another homework problem having to do with the notes receivable. Here we've got more interest. We have Nina borrowed $5,000 from the bank. She signed a note payable promising to pay the principal plus interest on August 31st, 2015. Interest rate on the note is 6%. And we have to generalize the loaning of the money, the accrual of the interest, and the collection of the principal and interest. So we're going to go through all the journal entries for this in this problem. So the first one is journalize when we loan the money. So this is when the bank loans the money on the note receivable. So part A, loaning the money on the note receivable. These entries that we're doing, by the way, are great to write on that sheet of reference entries. These are very basic. They'll be used over and over as well. So lending money on the note receivable. So and we're doing this from the bank standpoint because it's asking about the note receivable. So when it says note receivable, it has to be the bank. So we're doing it from the bank standpoint. So when we make that loan, we've got a new asset called note receivable, and then we're crediting cash because we're giving out cash. And that's on August 31st, 2014. Our reference line is going to be something like to loan money, something like that. So this, when we make that loan, we're going to debit the receivable and credit cash because we're paying out cash, we're loaning the money, and that's what we do when we first loan the money. Now this happens August 31st, 2014. Now there, it tells us in the problem that the accounting year of Second State Bank ends on June 30th, 2015. So they don't have a calendar year. They have this 12-month year that ends on June 30th. So they made this note receivable August 31st. So this is where you have to count out your months. So in Part B, it's asking us for the accrual of interest at June 30th, 2015. So at June 30th, a certain amount of time has elapsed since August 31st. So what we're going to be doing is we're going to be accruing the interest. And how many months interest is the question. We made the loan on August 31st, so we start counting September 1st through the end of June 2015. So that's 10 months if we go through and count those months. So when we accrue the interest, what we're doing is we've got an interest receivable. So the $5,000 principal on the note times the 6% rate times 10 months out of 12. So we have to adjust for the partial year there. So the face value of the notes, the $5,000 times the 6% rate times 10 months divided by 12. We're going to debit our interest receivable and credit interest revenue. That was random, wasn't it? So it'll fit. We'll get it. Okay, so we've accrued interest at the end of the year. Our next sentence, our next requirement C, is to collect principal and interest at August 31st, the maturity date. So first thing we need to do is figure out how much interest we're going to be getting. We're collecting principal and interest. There was a 1-year note. We know we're going to get the $5,000 back, plus we're going to get a year of interest. So 5,000 times the 6% is $300. So we are going to get, the bank is going to get $5,300, right? Because that's the interest for a year. This is a 1-year note. They're paying it off. So the bank's getting cash of $5,300. Okay, so that's the 5,000 plus the 300. The 300 is a full year's interest. Now the other entries here take a little more explanation. Interest receivable. We need to credit what we already accrued for 2 months ago. So we need to credit the $250 that we had set up in entry B. Interest revenue would be the 2 months since we did the accrual. So that would be the 5,000 times 6% times the 2 months. We're talking July and August since we did our accrual entry. And then our credit is not showing there. It's off the screen. Oh. There we go. Okay, so our credit to notes receivable is 5,000. So we're wiping out the entire note receivable that we loaned back a year ago. Okay, questions on this? Just a reminder that on Friday we have that supplemental session at 8 a.m. and I know that I'm going over a couple more homework problems during that. We have the Chapter 5 homework due this week. If you're in Section 3, you also have a quiz. But other than that, have a nice weekend.